Anna, do you want to kick us off briefly and then we'll jump into it?
Yeah, absolutely. Thanks everyone for joining. I've just hit record. So we're going to be talking today to Chloe Barger and Caleb Basile at QoE Prep about the landmines that either kill deals or save you millions. And these are things that only an experienced QoE provider catches. So thrilled to have you all here. This is a joint webinar put on by Entrepreneurial Capital and QoE Prep. And so I'm going to hand it over to Grant to do an introduction on entrepreneurial capital, and we're looking forward to an active discussion today. Please feel free to ask questions throughout. It'll go into our written Q&A, and we will have a dedicated time at the end of the call, at least 15 minutes to answer your questions. So don't be shy about asking them. And Grant, over to you.
Thanks, Anna. Yeah, welcome everyone. And just so everyone has seen it, there's a little Q&A box in Zoom, probably along the bottom bar. You can stick questions in that at any time. We will be recording, as Anna mentioned, and we will distribute the recording to everyone who registered. So excited to jump in. I will just quickly share our agenda. This is going to be a little bit of me and then mostly Caleb and Chloe because we're very excited to hear their perspectives. The agenda that we have for today is we'll do some quick intros, which we've frankly already done, but we'll double click into those a little bit more. I'll share briefly how we think about quality of earnings from an investor standpoint, and then Caleb and Chloe will share about how they think about uh, basically leveraging their expertise to deliver really quality of earnings. And then the part that I'm personally most excited about is they're going to share some stories of interesting and potentially painful things that they've discovered during their diligence process, supporting buyers, and how they've dealt with those situations and the lessons learned and things that you can be on the lookout for as well. We'll do some quick takeaways and then we will share a time for question answers with all of us. But before we jump in too much, Caleb and Chloe, would both of you like to quickly introduce yourselves and then we'll get into the agenda?
Sure. Thanks, Grant. I'm Caleb Basile. I'm the owner and founder of QoE Prep, where we focus exclusively on quality of earning reports.
Hey, I'm Chloe Barger. I have about 6 years in experience in transaction advisory and doing quality of earnings. I was at a regional firm for 5 years before joining Caleb at QoE Prep last summer. And I also teach accounting at Auburn University. So it's kind of my background.
Perfect. All right. Thanks, guys. So really quickly, just from our perspective, we, as backgrounds, and maybe most people know this, we are entrepreneurial capital. We invest in people buying and personally running small, profitable, boring, enduring businesses. We have raised $12.8 million to invest in those transactions, and we love supporting folks that are taking on the joys and challenges of business ownership through the acquisition path. My really quick background is I started businesses 10 times, seven of which failed, two of which got acquired, and one we still own. And then my wife and I did an acquisition where I searched, we bought a business that she now runs herself. And then we've done one add on acquisition into that. And then I started investing personally in people's small business acquisitions. Then we raised a fund to do more of that. So it's been a lot of fun. And we have a team of myself, Anna, who's organized this. Peter is our chief of staff, and then Abdullah is our investment analyst. So small but mighty team, and really enjoy supporting searchers. And for every deal that we've invested in, both in the past and in the future, there's always been a quality of earnings done. And the reasons for that are many. We, as investors, and also the banks that are underwriting the debt, are basing their investment decision in large part based on the historical financials of the business. And it's typically underwriting based on cash flow. There's not normally a lot of hard assets that are securing an investment. We're hoping and assuming that the profitability of the business will continue. And oftentimes, as many of you probably know, small business accounting leaves some things to be desired often. We have seen, I'll just share a quick story of from our search process. We had one example where a business we were under LOI. We dug into the QuickBooks. This was even before any kind of QoE. This is just like our initial look through. They had been marking inflows into the bank account from debt. They were basically borrowing money from like Stripe Capital and things like that. And those are being marked by their bookkeeper as revenue. And so that significantly overstated both the revenue and the profitability of the business. It turns out they'd been losing money, they'd been massively overpaying taxes, and that deal obviously fell apart. So, and that was obvious. And And Caleb and Chloe catch things that are far more subtle than the obvious. But everyone, and yourself included, is trying to understand whether the historical financials and equality of earnings does a very deep dive into, are those historical financials correct? Most of the time they are maybe close at best, but some tweaks need to be done. And they're the folks that do that and help you have a firm foundation to make your investment decision on. Typically, most small businesses are not run on accrual accounting, which means they're not necessarily matching revenues and expenses to the period in which they're taking place. And that can lead to all kinds of interesting fluctuations and is often a very extensive project to get a true sense of like, how is the business operating economically and not just on a cash basis. And quality of earnings can help with that. It always helps as well. Like, you as the searcher are looking at a business. We as potential investors are looking at the business. We've just really found it helpful to have another set of eyes that is coming from a very quantitative, very financial lens, looking at the transaction, and especially people that have seen hundreds of deals and seen all kinds of weird stuff blow up in the faces of various buyers. It's just hard to beat that pattern matching. And so that is another reason why we love having quality of earnings folks. And then the final thing is that often pays for itself through negotiating leverage, where you find things that are actually that probably the business owner did not themselves know in many cases, especially it's a small transaction. And you can bring that to them, and sometimes that results in a purchase price adjustment. And on average, I would say that quality of earnings pays for itself and then some, both in avoided bad deals, but then also in adequately and fairly priced good deals. It's not always what happens, but there are definitely times when there are changes in understanding as you proceed in your post LOI diligence. And whether or not you decide to bring that forward for renegotiation is, of course, your decision. But it's good to have that in your as an arrow in your quiver, and just to be making a fully informed decision as you approach that. So that's our perspective. And let me turn it over to Caleb and Chloe to share a little bit more about how they approach QoE and how their experience is going to be helpful.
Thanks, Grant. Yeah, funny you mentioned a company that was recording debt as revenue. Most of you have probably heard of a little scandal called Enron, and that is what they were doing, except they were doing it on purpose. And so because of that, we have the Sarbanes-Oxley Act of 2002 and all the internal controls regulations and all of that. And so, yeah, it's critical that somebody's looking. And again, of course, that was a fraudulent, very intense scandal. And then a lot of our smaller companies that we're looking at, they may just be doing it on accident. Like, it may not even be fraud. It could just be that their grandma has been doing their books for the last 20 years and she doesn't know that that's not revenue. And so she's just booking it that way. And so I'll say first, what we're doing, I always like to tell targets and buyers that, as the QoE provider, we are not on anybody's side in particular. Of course, we are being hired by the buyer typically, but, we want it to be a fair deal for everybody. We're not going in trying to catch fraud or find fraud, and we're also not going in trying to destroy their books. And if we see something great that you didn't know about, we'll tell you that too. We want to have a fair and equitable deal for everybody involved. That's kind of the goal of equality of earnings, is to have that quality earnings. We want to make sure that earnings are accurate and complete as possible. And so how having an experienced QoE provider helps you as a searcher. First of all, we catch risks that can potentially kill deals. There's lots of things involved in that. We have concentration risks, operational weaknesses. We may have margin inconsistencies year over year that we want to dig into and make sure that they're actually normalized across the period that we're looking at. There may be working capital pitfalls that that the investor or the searcher or buyer may not immediately see. So these risks are not typically going to be visible in broker materials. Obviously, they're not going out to market advertising any risks that they have, but they also, again, may not know about them, especially when we're looking at smaller acquisitions. Often, like Grant said, the financials can leave a lot to be desired. We have some unsophisticated sellers where we just do need to dig in a little deeper and make sure that things are being put in correctly. A big risk, the clearest risk to me, I typically see outside of, the standard ones is concentration risks. We have concerns about the sustainability of a business that only has one major customer or has one major supplier. If we, if, and making sure that that is a situation that's going to continue. So great, they have all this revenue from one customer. Is that customer going to stay with us once we acquire the business? And if not, then there's no revenue. So, and that's obviously an extreme example saying one, but that could be 20% of their customers make up 90% of their sales. We want to dig into that and make sure that that's sustainable going forward. Second, we use data provided by the seller and external data, so bank statements, tax returns and things like that, not just the narratives to validate the story. So often, searchers are just talking. It's a very relational environment. You're talking to the owner. Owner has spent their life building up this business and they love the business. It's their baby that they've raised from infancy and now to adulthood. They're ready to put it out in the world and they see no flaws with it because it's theirs. That's what they're telling you. You're listening. Obviously, you're using your own professional skepticism, but you're still only hearing their side of things. So we go in and actually look at the numbers and make sure those numbers can validate the story that the seller is presenting. Next, we deliver fast, investor-focused insight for better decisions. So we at QoE Prep, at least, we only do quality of earnings. Many accounting firms do lots of different things, and some of them also have very specialized quality of earnings teams that can do just as good of a job. But you also have smaller firms and places where maybe the same people are doing the audits and the taxes and the quality of earnings, and they may just be split a bit on what they're looking at. So having a specialized quality of earnings team that doesn't kind of dip their toes in all of the waters, we can offer faster turnaround, have a clear buyer-oriented analysis that's focused on you and what you're looking for. And from our side, our firm, we can typically turn that around in 2 to 4 weeks, depending on the size and depending on data flow and everything. But try to focus in and really do a good job there. And having that speed is important as you focus on closing the deal, because a lot of these things, deals don't sleep, they constantly are going. And so kind of needing to get all of that information. And finally, we reveal the real earning power of the business. The whole purpose of quality of earnings is to get to normalized earnings and normalized EBITDA. We want to see what the real earning power is and if it's sustainable over time. We will strip out non-recurring, owner-related, non-operational items that inflate seller-reported EBITDA. So again, sometimes that's purposefully inflated, sometimes it's not purposely inflated. I find that it's often not purposeful. I have not had a lot of experiences where I have felt like the seller is trying to pull one over on us. It's often just a more optimistic view of their own business. And so we're able to kind of make sure that that's all realistic. We don't want, a seller comes in and says, oh, you won't need a building anymore. They may not be lying. They really think you don't need a building anymore, but you do. You're still going to need to rent a building. And so we'll add that rent back into their EBITDA and make sure that everything's included. But without that expertise, a lot of times buyers can dramatically overpay based on distorted numbers. So we want to make sure you're getting a good deal. And again, because we're a third-party provider, that's helpful because we're not, we're on your side and we're also wanting to have it be fair and equitable for everybody. I'll turn it over to Caleb for the next part.
Okay, we might be on mute.
Never heard that one before. All right. Thanks so much, Chloe. Grant, if you don't mind just kind of like not stopping the slide, I would just kind of I want to
Yeah, yeah.
connect with people a little bit
Perfect.
more and just share face to face some stories I've seen.
Oh yeah.
Uh, yeah, so during my first internship, an advisor told me, Caleb, there are three financial statements for every single company. The books to pay your taxes, so that you don't have to pay a lot. The books to raise money from investors so that you can actually get the funding, and then the actual books so you know what's happening. And I thought to myself, that is so unethical. 10 years later, me and Chloe have worked on a combined of 500 deals, and we realized, you know what? There actually are three books. You got the financial statement income, the tax returns, tax income, and then the bank statement income. Now, sometimes they're off by little, sometimes they're off by a lot. And we wanna test that to see how far they are off. And it's okay for it to be off by little, as long as those variances are explainable. But sometimes they're off by a lot. So, and most, as Chloe was saying, most of the times they line up pretty well. So, what I just explained to you is called the financial verification process of the Q of E. It's the book to tax reconciliation, the proof of cash reconciliation, and payroll reconciliation. That's the one we also throw in. Um, but we want to make sure that all their financial statements are lining up with each other. Because if someone is um, Grant gave the example of someone overpaying taxes. Hey, they may have been lying about their financial statements, but at least they're paying a lot in taxes. Typically, I see the opposite, where they're paying a little, their taxable tax returns are showing a lower amount and they're paying a little bit less in taxes. But then when they go to sell the business, they're like, yeah, we're making a little bit more than what the tax is saying because it's tax strategy. Sometimes it is tax strategy, sometimes it's, trying to pay a little bit less in taxes. Um, but it's really interesting because when you evaluate a business, it's typically off of an accrual basis. But when a lender, and off of their financial statements from their accounting system, but when a lender evaluates a business, they're only going to underwrite it off of the tax returns on a cash basis because it's the most conservative one. So doing those three reconciliations can help you. I don't know how to say this right, but kill a deal early if it's a bad one. So I had a client who told me, he's like, Caleb, you're the most pessimistic advisor on my deal team, and you're the one killing this deal. And I said, look, I do not kill deals. That is not my role. I give you the financial report, the quality earnings report as I see it, based on their numbers, based on their story. If that ends up killing the deal, is because the broker and seller did not they weren't set up properly for you to see it. Yeah, so let's talk about some stories, some some deal killers. And Chloe, you can jump in if you have any in mind, but I'll just kind of start talking, but go ahead and jump in. Um, the fastest deal I ever killed was during the first introduction meeting. I had gotten their financial statements, I put everything together, and I asked the question. I said, "Hey, why are things lower in the past 3 months? Like, what's slowing it down?" And the seller said, "It's seasonality." So I pulled up my seasonality chart because it's literally just looking at revenue per month. So it's an easy chart you can do right in the beginning. And I said, "Oh no, last year at the same time, you guys actually had a pretty strong summer, but right now it's a lower summer. Is there another trend, something else to the story, a competitor? Can you think of anything as to why it's going lower?" And they didn't respond. The meeting ended. My client emailed me and said, "Hey, we're going to move on. We found out that there's a really good competitor and that there actually is a downward trend in revenue." So it wasn't me that killed the deal. It was the business owner wasn't being fully transparent or truly did believe that it was a seasonal thing. Unfortunately, he had a really good the previous year he had a really good summer, and this year was really bad summer. So to me, it appeared as though it was more just a downward trend in revenue. And then my buyer saw that there was a great competitor that had a better option that people were turning towards. Um, so that was a probably the fastest deal that ever died. It was within like 2 hours of just analyzing the data. I was working with the buyer and the seller. He wasn't disclosing that like three of the team was family members or relatives, and those relatives or family members were either going to want to leave after buying or get paid at market rate. They were being paid a little bit less than average because they lived at home or the owner was doing them a favor. So once the buyer found that out, he realized that there's a concentration risk of basically the family members. Everyone hears about customer concentration. A lender's going to be very unlikely, or they'll want better terms, or they're less likely to lend on a deal if there's a single customer that represents 20% of the revenue or more. When we look at the customer concentration, we like to look at customer churn and new customers, and we want to understand like what's happening with these customers. So if a seller represents that there's that like the top five customers are only showing 30% of the revenue, but then one time I looked at the customer list and yeah, it did look like the top five customers were representing 30% of the revenue. But for one customer, there was like five different names in five different locations, and that customer actually represented 40% alone of the revenue. So that ended up allowing the buyer to retrade for a better price. Um, time is a big deal killer on both the sell side and the buy side because it's two people deciding to make a transaction. If a seller feels like the buyer takes too long, and they're coming close to the end of the exclusivity, the broker might say, "Hey, look," and the broker, it's their right. Once exclusivity is done, they can say, "Hey, let's look for another person," or "I think we can get a better offer here," because the broker's job is to get the deal to close, and they care about that just as much as the highest price. So they really want to make sure that they're going to close. So if it's going slow on the buy side due diligence, a seller might walk away. If it's going slow on the buy side due diligence, and like you as a buyer are looking to buy a company, but the seller is not giving a lot of documents, that's going to make you question. That's going to make you start like, one of my buyers told me, she was like, I'm not married to this company. I'm dating them, but they're not giving me anything. They're saying go date someone else. So they're not letting me do my financial due diligence. Why aren't they giving me that? And they ended up looking for another company because they weren't giving any data. So like lack of transparency, that's going to be something that might make you walk away. Um, I had a LinkedIn post. It 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 was about the number one signal that the deal won't close is a buyer on vacation and them not providing documents that you ask for. If those two mix together, only 20 to 30% of those deals are going to close. And that's just from me reviewing deals last year. Okay, of the 40 deals we reviewed, if that combination happened where the buyer, where the seller, the business owner was on vacation, and they weren't providing documents, that's a pretty big red flag that the deal will not close. Um, that's from a small sample size so take it with a grain of salt. Uh,
That matches our experience as well, by the way. We have never had a deal where the buyer has gone on vacation and been sort of incommunicado during the transaction process ever close.
yeah, you mean the
Which,
business owner or the
yeah, the
buyer?
business owner, sorry,
Yeah.
yeah, the seller, yeah.
Yeah, so it used to be a flex back in the old days, like, haha, my company can run itself. Look at my team, they built it all. But now it's just really like, come on, provide the data. And I think it's kind of changing because the quality of earnings got really, really big in 2020. You used to buy companies off of a multiple of revenue, and you looked at EBITDA as well, but it was really off of a multiple of revenue. You're buying the staff, you're buying the customers, and it was a business buying a business. But ever since like ETA started, and it used to be, and now it's like an individual buying a business, you look at earnings more. That's kind of become the gold standard or adjusted EBITDA, which leads us to the next thing, the add backs. bad add backs kills deals. So like if someone's adding back a lot of personal expenses that they can't provide support for, or one-time expenses that really are operational expenses, they just made bad decisions, like a bad hire or bad marketing, like that will not pass a lender approving it as an add back or the quality of earnings approving it as an add back. Um, at least that's the way we do it. So I think maybe some QoE providers will allow it, but that's still something to look at. Like when you look at their total at how much of their adjusted EBITDA or adjusted SDE is going to be is made up of add backs. So depreciation, interest, taxes, and this is only federal taxes paid. Those are add backs that are in the definition of EBITDA. They'll always be added back. The change in owner pay to your pay or the new manager pay, that's always going to be accepted. Go forward rent, that will always be add back. So like if they're paying above market rate for rent and you're going to be paying below market rate, then you're able to get some credit for that. But marketing, that's going to be kicked out. Personal expenses, so that's kind of like okay, they're saying travel and auto and meals are all personal, but then they deducted it for tax purposes. So that's something that yeah, you could kind of add back, but you got to make a note of it as well and say, like, hey, they took these expenses as business expenses for their tax purposes. So, so that's kind of a judgment call whether we add it back or not. Um, one interesting and I guess, Chloe, I'll open the floor for you after this story if you want to share some. But one interesting thing that we've seen recently is that like if a business owner is about to sell a company, um, we'll look at repairs. If repair for like machinery or equipment type companies, if repairs goes down in the last year, we always ask, is there any equipment or anything that needs to be repaired that you haven't done? And if they say no, we'll say, well, why are repairs lower this year than last year? Because sometimes there's some expenses that it's not going to be on the books, but are expenses that you need to do in order to get get the business running. All right, Chloe, take it away. Your volume's a little weird.
It just sounds like you're underwater a little bit. Let's see. Yeah, it's still
No.
strange. It was great before. I wonder if the microphone switched.
Yes, if you have two microphones. I'll tell another story while she's doing that. Let's see. Sometimes I
I,
just
I have a quick one, which I'll say is the
sure.
mirror image of the deferred repairs and sort of pushing off repairs. We've also seen, and um, this is sort of like it's on the sales side where basically the sales pipeline has not been pursued as aggressively as it has been historically, especially in the couple of months leading up to close. Business owner is probably really busy with the transaction itself. If the business owner is involved in business development at all, that tends to take a back seat. We invested in a transaction. This is me personally outside the fund, but the the pipeline had basically shriveled up to nothing by the time that the searcher bought the business, and that ended up being a very intense first year of having to rebuild the pipeline and sort of stabilize everything. And it ended up being great. The searcher's awesome and the business is doing really well, but it was a big um, it was a big lift right at the beginning, and it wasn't expected because it just wasn't on any of our radars, and it is now, but at the time it wasn't something that we were paying close attention to.
No, it's not working.
Hold on, let me try one more thing. It's not-
All right.
Is that
Yeah.
better?
Oh, yeah, it is.
Okay. Well, I had three microphone options. Sorry about that.
Three
I
options.
don't have any idea what other microphone I could be using, but I was just gonna say I don't have a specific story outside of the things Caleb was talking about, but I like to think of equality of earnings as a whole as like when you're buying a house. When you have, your appraiser come and your inspector come. So when I've bought two houses, and both times, your inspection report is a mile long, not because the house is bad, not because, I mean, sometimes it is, but not necessarily because something's wrong, but just so you have all of the information. So I know because of my inspection report that I have a an outlet in my bedroom that's not properly linked up. However, I don't know anything about electricity, but it's messed up. It's not good. But I didn't care. Like some of the things that a quality of earnings is going to find, it's not going to matter to you. You're going to say, okay, like that's a tiny, there's one shingle off on the roof. Okay, great. Like that's just buying a house. That's buying a company. Every company has issues. No company is a perfect company. If you got an inspection report back for your house and it had nothing on it, you would be concerned that you didn't hire a good inspector because the brand new homes still have issues with them. And so I just think of it that way. And like Caleb said, we're not killing deals in the inspection report. The inspector did not kill the deal. If my inspector came and had all these issues, I wouldn't be like, "Ah, I can't believe you ruined the house." No, like he didn't ruin the house. He just told me what was going on in the house. And then I use that information to make a decision about whether or not I want to continue to buy the house under the contract that I have. If I want to renegotiate the contract and say, hey, seller of the house, I need you to, give some concessions or lower the price or fix some of these things. Or if I just want to walk away from the house completely. And so sometimes putting it in that perspective is a little easier, especially if you haven't purchased a company before, but maybe you have purchased a house. It's honestly really similar. There's a whole lot of things you go through when you're buying a house, and buying a company is just like that on a bigger scale, basically.
We have a question from Ryan about the pipeline. How do you catch the pipeline getting less tension during due diligence from the owner to avoid that situation? I can comment, but Caleb, I don't know if you'd have any comments on that as well.
Yeah, you can go first.
For us, so the gold standard would be they have a highly regimented sales process that's documented in a CRM, and you can pull historical reports for now versus the same period a year ago or in past years, and you can get a sense of like, okay, what is our weighted pipeline then versus now, and has that diminished? Oftentimes, you're not in a world where it's that cut and dried, and so it tends to be, and that wouldn't have existed in the business that we'd invested in. I think we would have been able to at least get a sense of it by talking in depth with the owner about who are the current prospects in the pipeline, what stage of maturity are they at, and what's sort of a reasonable timeline. The searcher in that case, this is a manufacturing business. He had a manufacturing background, and so he would have been very equipped to have a good bullshit detector, frankly, to see if things were at a good stage and potentially high potential near term sales. So my suspicion is, had we had those discussions, the problem would have been identified, but we just didn't think to have the discussions, a couple of years ago.
Yeah, so I would just add there's lagging and leading indicators. Number one, are they getting less and less five-star reviews on Google? If that's the case, maybe they're not producing as much work. Number two is revenue over the last few months going down. And then number three, what is their actual like backlog that they have signed up right now versus the same time last year? And this means like actually signed up, not potential. And then number four is what Grant said. You could pull with their CRMs to see their potential new clients.
Backlog is a great comment because yeah, that would have been really insightful in this case. We would have seen the weakening. Yeah. And the searcher's been awesome. He's an absolute killer and the business is doing great, but yeah, stressful.
Yeah,
Okay. Yeah. Oh, good.
I was just say to your point, like, and to Chloe's point, like, if a QoE doesn't come back great, you could still buy that business and do great. Like, the financial piece of it is just one part of it. As much as I like to think it's the most important part, it's just a part of it. You also need to look at the market and look at yourself. Like, are you able to do better than what that current owner is doing? So yeah, good point,
Yeah.
Grant. That
Yeah.
turned it
Yeah.
around.
Another great question, and we can open it up. Questions, feel free to submit them, and we'll just continue to sort of spitball here. But great question here. Someone says, just had an IOI accepted. I proposed a majority bank loan, and the seller has now offered to seller finance 70% of the deal. I'm a bit skeptical. What would a seller be hiding by not launching a bank loan? Curious if you guys have ever seen circumstances around that, because on the face it
So,
looks great, but yeah.
yeah. Is it manufacturing and construction? What's the industry for this one?
Glad if you're able to share. We'd be curious.
But at a high level, lenders, they pay 1% referral fees, and we have never gotten a referral fee from a lender um, to remain independent. But they'll pay 1% referral fee for to anyone that sends them a borrower, whether it's a buy-side advisor, a loan broker, or a sell-side broker, someone who's selling a company, they can get paid that 1% fee. So it looks like maybe they've tried to get a pre-approval for a loan, and the lender's like, "Yeah, I'm not lending this. This is a really bad company." I don't know. I haven't looked at it, but if a seller wants a higher percentage seller note, it's because either the bank won't lend it or because they're wanting to give you favorable terms for a higher price, and they just want the higher price, and they're willing to bet on their company. A lot of people say, yeah, you got to do a seller's note because you got to bet on your own company. But from my perspective, and it's okay to have a difference of opinion, I'd say probably 40% of owners would agree with me. I'd rather just the money up front, even if it's a little bit less, because I don't want my money with you. I don't know you. I don't know if you're going to run the company good, um, or a buyer. I've been told I
Yeah.
shouldn't talk so directly to people. I don't know if a buyer is going to run my next company as well, as I am, but I'd rather just the money up front. Um, than the arguments like, well, if you put a seller's notes, because that means you really believe in your company. And I do believe in my company currently, you know.
Yeah.
Yeah, that
Yeah.
as I guess, all right.
No,
Um,
that's great. And a little bit of additional context. The business is landscaping, contracting, and did find their books are on accrual, and 58% of AR is 120 days past due.
all right. So the AR past due for landscaping, that is pretty, it's probably more common than other industries or landscaping construction. Um, you want to talk to them about their biggest customer. It's probably one of their top two biggest customers that's paying late. Or maybe there's a few customers that don't like the work that they did, so they're not going to pay them. Ask them about factoring if they ever factor their AR. And basically that means they sell their accounts receivable, they sell the money that's owed to them, and they get like 90% or something like that. See if they do any of that. But if AR over the last 12 months is going up, up, and up, that shows a problem. Two problems. One, they are over recording their revenue because they're recording 100% of what they build, but not the net of what they should actually get. Because let's say I bill for $100,000. Of those $100,000 over the 10 clients, I get paid $90,000. I can really only record $90,000. So it's 100K of revenue, 10K of bad debt, so 90K of profit. But they're recording that 100K of profit. They're overstating their revenue. That's
Unless I will just say, I would also just look at bad debt expense that's on their books and their allowance for doubtful accounts because their accounts receivable aging would not include that allowance. And maybe they are allowing for that. So it's just hard to say without seeing all the books, but definitely would be worth looking to, sometimes I had a client in a similar industry and they said they had like Home Depot or somebody owed them tons and tons of money and it was super aged and they're like, I mean, Home Depot's going to pay us, but Home Depot's so big, it's really just kind of whenever they want to. We're not going to stop using them. They're not going to stop using us. And so, depending on the customer, occasionally that can be explained, but definitely, at least an orange flag that you want to look into.
Yeah, and
Yeah.
then also I'd add to that the percentage of AR compared to total revenue. How large is AR? Because if it's a small percentage, it doesn't matter. If it's large, it really does matter.
Yeah. Bad debt is under 1% annually. Is so anyway, yeah, that's great. Yeah, fascinating situation. And definitely it sounds like more analysis to be done. We have another question, which is if a company is structured as an S corp, this is a potential acquisition target. It's structured as an S corp. And it appears for taxes, so maybe it's an LLC filing as an S corp. It appears they've been underpaying themselves. The owners have been underpaying themselves in salary for the size of the business. Can that be a tax liability for the future of the company? And just to clarify, the owner is probably paying less than a market salary, probably because salary is taxed at a higher rate than distributions are in an S corp. So curious how you guys would think about that.
Yeah, so you get to avoid the payroll taxes, Social Security, and Medicare care taxes. So if it's and this is not our forte, this is more legal due diligence, but from my experience, if it's an asset purchase, typically that liability is with the previous owners. But if it's a stock purchase, it can go with you, but then you can get a lawyer to write it in such your LOI in such a way to any previous debts that are not discovered beforehand are with the previous owner. So that's what we've seen in our experience. That is not advice. Talk to your lawyer or whatever. But like that, yeah, that is definitely more of a lawyer question or tax due diligence question. But yeah, from what we've seen, that's the reason why they're paying themselves less. But then that's an add back as well, a negative add back. It lowers adjusted EBITDA because you got to lower it from. They're probably paying themselves like 50K, but for that position, they should be paid 150K. So you lower EBITDA by 100K or something like that.
Love it. Yeah, one of the many benefits of the asset purchase versus the stock purchase. Um, okay, cool. Okay, could you discuss the risks associated with purchasing a business that has only been operating for a few years? Is there a minimum operating history that you typically want to see before considering an acquisition?
Think it really depends. I know that's not really a helpful answer, but I think seeing just a few years, it really depends on the industry. If you want to share what industry that is, but a lot of people do that on purpose. They'll, create a business with the intention of selling it within a few years, and I think that sometimes that's really great for them. It could I guess that's the question. Why are they selling? Are they selling because they, you know, feel that this is a good time to exit for themselves, or is it that something's wrong with the company? And like I said, I know that that's not the most helpful answer in the world because I'm saying it depends, but it really depends.
Yeah, it definitely depends. I think for lending purposes, they like to see 2 full years in TTM. So that's banks and their risk appetite. Another interesting question. I was on the buy side, and the seller's like, we're basically explaining that, like, based on their last 3 years of profit and loss and their adjusted EBITDA, their business shouldn't be worth 4 million. It should be worth closer to 2 million because the adjusted EBITDA is 50% lower than what they implied in their sim. And the business owner goes, we've been in the city for 40 years. You're telling me that 40 years does nothing for my valuation? Um, and every buyer's different. Some buyers love that. They love the history. They want those legacy firms and they're going to pay more for it. Other buyers want the newer firms because they're more in growth stage. They're going to grow faster. Now, it's typically a lower multiple for them, but some buyers would prefer like a newer business. So it really, yeah, as Chloe answered, it depends.
Love it. Love it. Okay, cool. Anyone else who has questions, feel free to stick them in. I have one question I'd be curious to get both your perspectives on. Are there weird nuances that you had to experience, and maybe this was years ago at this point, but had to experience the hard way? I've heard interesting stories about the perils of, for example, like custom manufacturing businesses where the inventory is just really hard to get your arms around because it's at various stages of completion, and how those milestones are being recognized influences profitability, can potentially inflate profitability, and can be a disaster, deliberately or unintentionally on the part of a seller, because there's just a lot of games you can play with things like inventory in a custom manufacturing world. Are there other industries that you see people often looking at where you now are just particularly cautious about certain areas because you've had the scars and diligence?
In the healthcare industry, you always have your billings and your collections. And I was very young, very new when I first started working on healthcare jobs, and I was so confused because at first I thought it looked bad, their billings are super, super high and their collections are super, super low, but that's actually just how the industry works. We have a bill rate for, for a dentist, for a cleaning, and for a cavity filling, and all these things. We have these bill rates, and then what insurance actually pays is a lot less than that. And sometimes your gross collection rate could be as low as like 65%, and that'd be good, which is wild. It doesn't feel right. But then you look at those things, you look at
It's like
your,
a D minus.
yeah, you look at your bill when you've been to the hospital, and then you look at what your insurance pays versus what you pay and all that. And it's a lot lower than the original bill was. There's lots of negotiation that happens there. So just making sure that they're recording, their collections rate should be what they're recording as revenue. Because we don't want to overstate revenue and be recording billings if we're only getting a certain portion of that. And then there's some healthcare, like to be clear, 65% is not, industry average. It might be a specific part of healthcare average. And then some healthcare organizations, their gross collection rate will be 99%. And so it just totally depends, and really looking into that, and knowing what the industry standard for that specific type of provider is can make a huge difference when looking at the quality of earnings.
Any other
I,
industries that you particularly, yeah, Caleb?
yeah, I was going to jump into the accounting industry. I mean, it's what I come from. But like in addition to like the normal QV, the quality of earnings analysis, you want to look at the staff a lot because when you're buying an accounting firm, if it's a business buying an accounting firm or an individual, you're buying the customers and you're buying the people that are actually working. This was really, really big the last 5 years because there's what do they call it? There's a lack of accountants, the accounting crisis or whatever they call it. But now everyone says AI will take our jobs, and maybe it will. I don't know. Or maybe it's just going to help us do more work, do more with less. You hear all these things. But everyone underestimates how fast people adopt new technology or adapt new technology. Like there are people still doing their financial statements on green sheets or using Excel for their entire financial statements. So just because QuickBooks exists doesn't mean you're going to accept a better technology. Back on the point of buying an accounting company, you got to look at the individual employees, what their utilization rate is. So of the 2,080 hours, so 40 hours times 52, how many hours are you actually working? In general, the low-level staff should work 1,700 billable hours, mid-tier 1,500, director 1,200, partners should really only be working 800 billable hours and then be doing business development. That's for like a small size company. For mid-sized companies or the larger companies, the hours go down because they have so many meetings and it's so much training and so much corporate stuff. So I like to look at what's called utilization. And then there's also realization. How many hours, so like let's say you work 1,700 chargeable hours. Of those 1,700 billable hours, of those 1,700 billable hours, do you have to write anything off? And if you have to write off like 10%, you can only bill for 1,540 hours. Um, so I like to do those metrics and give it to my buyer, just so they can see that the team that they're going to be buying, like whether it's a good team, whether and people view everything differently. Is a low utilization rate good or bad? Some will view that as good because you can get more work in without having to hire more people. Some view it as bad because they want everyone on their team to be hard workers and to like work as many hours as possible, and they view it as a culture threat. I think the truth is somewhere in between. You don't want a team that has the highest utilization or the lowest utilization. But again, it's case by case.
Totally. Totally. Any parting words that either of you would share with folks as they continue on their search journeys? And then I'll share contact information for everyone in case people have follow-up questions after this.
Thanks for having us. We're always happy to share and always happy to talk through questions and things. And If any of you, I'm pointing at the list as if I can see your faces, which I cannot, but if any of you ever have any questions or wants to get in deeper on any of these things, we're always happy to talk to you. Like Grant said, he'll share all contact information. So we'd love to
Yep.
connect.
Yeah, to second Chloe, we do offer free consultations pre-LOI if you're looking at a business and just want to run the numbers by us. We're not going to charge you until you actually sign the LOI and are ready to kick off the QoE. Because sometimes we can kill deals really, really fast, which I don't know if that's a bragging point or maybe that makes you not want to talk with me. But in the beginning, we talked about saving you money by either helping you buy the right company at a better price or avoiding overpaying for a bad company, you know. So that's what we're here to do. So thanks
Yeah.
so much, Grant,
Or
for having us.
the worst of all worlds, where you do a lot of time and spend a lot of money in diligence for what is ultimately a bad company that then falls apart because it was a
Yeah.
bad company
Yeah.
this whole
So
time.
if we kill the deal, we're killing it fast for you.
Yeah. Yeah. Cool. Well, thanks, guys. Thanks so much for spending the time. Caleb, your email, if I believe, is just caleb@qoeprep.com. And
Correct.
yeah, and you're on LinkedIn and all over the place. Obviously, Chloe on the QoE Prep team and here to help as well. So thanks so much to both of you for joining. Thanks for the great questions, everyone. We will share the recording and the slides via email after this. And anything we can do to be helpful, just let us know. Hope everyone has a great rest of the day.
Thank you.
Talk to you.
Thank you.